Good evening. This is Ken Long at Tortoise Capital with a review of the solution for our quiz from 19 April 2017. So this is our starting blank, and we're looking at symbol XIV and 1 minute charts. And just a quick look at what we're examining. Notice on the left hand side I have the volume at price indicator, so we can see how many shares are being traded at what price level. This is like the market profile that gives us an idea of where the support, resistance, and trader activity is occurring. The orange line is the volume weighted average price, the moving volume weighted average price. That gives you the mathematical fair value of the day as it unfolds, and that just integrates all of the pricing at different volumes to give you the mathematical fair value. We're using bar charts. What we call the river is the 30-period Bollinger Band, plus or minus 1. That's the dark blue area, with the center of that being a 30-period simple moving average. That's the thick red line. The outer red lines, the outer boundaries, are the 30-period Bollinger Band plus or minus 3. So you have plus or minus 1 is the river, that's dark blue. The light blue is the floodplain, and that's a 30-period Bollinger Band plus or minus 2. Then the outer red lines plus or minus 3. That gives us the ranges of normal and excursions during the day. The regression lines that we use are the 10-period moving regression line, that's blue, that's our proxy for price. The 30-period regression line, the RL30, is the black line, which is the slow regression for us. That's the 10-30 pair is what gives us the slow fast and helps us identify the patterns for P1 through P7 in the RLCO framework. To compute fair value long term, we look at this purple line, that's the 270-period regression line. And so if that's the long-term fair value, then the blue line, the short-term, the RL10, gives us the trader's price. That's a smooth moving average of price using the regression lines. And so the difference between, like for instance, at this point, you see the maximum divergence from RL10, or the trader's price, and the RL270, which is the long-term holder's price. That differences in those two opinions is what creates tradable moments for us in some of our strategies. I include an intermediate one. The green line is the RL90, because that's the regression line between the 30 and the 270, and that gives us an intermediate estimate of price activity. And then by combining these in different pairs, we're able to see what the 10-30 relationship is on higher time frames. So the 90-270 is the same as the 10-30, but up on 9 or 10 minute charts. So we can infer what's going on in the higher time frame by looking at these regression lines on these time frames here, without having to shift our orientation. So this is one trading day in XIV. Kind of typical movement for XIV, and what we want to do is notice various characteristics of movement that are based on these statistical measures. So this is how we would mark this up as we're evaluating opportunities and learning to understand how our trade target operates. So the first thing I want to look at is this divergence between the volume weighted average price and the maximum excursion of the RL10, or the price, and that occurs at this location. That's how far, in our view, traders were able to move price away from what at that point was the fair market value, or the volume weighted average price. Volume weighted average price matters to us as traders because the longer term time frames, swing trades and position trades, in professional money is being measured by their performance and its improvement over volume weighted average price. So if I'm a broker executing a large buying program for a mutual fund or a hedge fund or whatever, if I can get price improvement where I'm actually buying compared to what the posted volume weighted average price was at the time, by the end of the day, then I'm going to get to keep some of that price improvement. And so that's the incentive for institutional money to improve their entries, and that's why you see differences between volume weighted average price and actual price. So if I come in at lunchtime, somewhere between 12 and 1, and I'm trying to estimate what I think trades in the rest of the day might be, one of the things I like to do is compare the maximum excursion so far from the RL10 to the volume weighted average price. And then I can use that as an estimate to say, if my hypothesis is, if we're going to see a reversal from this extreme moment, how far can it go? First, to get back to the VWAP, I can measure that distance and say a price return to the VWAP would earn me that much. And then, if that momentum generates additional trading activity to overcorrect or overreact, then it stands to reason that if traders can move it this far from the VWAP in one direction, that they can move it that far from the VWAP in the other direction. And that allows me to estimate reasonable intraday price movements when I'm framing trades and I'm looking at momentum. So if I have seen this kind of a move already during the day, I can hypothesize a return to the VWAP is not surprising, because that's where, at the end of the day, the pros are going to settle up their performance. And then if that momentum generates more movement, then the far side could actually achieve this far. And you see in the example that, in fact, it got most of that move. The next thing that I'm going to add to this is my appreciation or understanding of where the trade momentum is in terms of the long-term trend, or the RL270. So what I notice in here is that the RL270 acts as a sine wave, and again, that's the long-term fair value of a couple time frames higher than mine. So if my price as a trader is the RL10, and I go up 2 iterations, the RL270 acts as fair value. And now what I can see is that during this price movement, this was enough of a short-term price movement for the estimate of fair value for long-term to roll over and to decline. At this moment, what I notice is that after price improvement from here, leg 1, leg 2, and starting of leg 3, to get back to the VWAP, that was enough to convince the longer-term folks that the selling was over and that it had gotten flat and started to improve. So I see this as an indicator that represents, for me, the psychological condition of the long-term holders. And so any dips after this moment, I'm going to interpret that as the long-term buyers are prepared to add to positions and buy on dips, and that makes this trade frame a possibility now, because we have favorable momentum for the long term. It has come back momentarily to fair value. Then as I project what a reasonable intraday move is still available, I can now forecast pretty closely what that move actually became, and I can look to make this trade for that leg with statistical support for my decisions. You'll notice that the size of this leg is the size of that leg, and that this is the initial overshoot. Now, once I have the overshoot, I can now say, look, as this is not making new highs, you see the RL90 is rolling over too, I can now say that this move from the VWAP up into this diminishing energy, this is a good place to be looking to cover my positions from any entries along this leg on the way up. So that's what we are inferring from the RL270. I want you to notice that I've marked off now in stage number 3, I'm looking at the maximum southern movements, or the maximum adverse excursions of the RL10 or the price, and I notice this rising lows. That now gives me reasons to look for entries on the upside after this significant move to the downside. So I like to look for rising lows, and now I'm going to be looking for what we call the emerging dragon, or the not later than entry on the move up. So if I see this maximum excursion and then this first leg and then it rolls back, finds support here at what used to be Z1, Z minus 1, or the one period Bollinger Band, and starts moving up. When I get the RLCO pattern here outside the river, I already can see at this point that I've got a low and a higher low. Now my point is, if I want to get into this trade with the idea of initially getting back to the VWAP and then to the VWAP excursion, this yellow dot represents the not later than entry, or the emerging dragon. So what I do is I take a look at the 10 period Bollinger Band and the hump of the dragon, or you can use the proxy, the hump of the RL10, the upper period, and I draw that line across, and I say that in this move between P1, which is the RLCO outside the river, and this is my region for discovering an entry that takes advantage of this momentum. And this is my not later than entry, that if I can't find a reason to get long inside here, then this can become an automatic entry because it's taking out what was resistance, and now I can make this entry with my stop down here at Z2. So this is a not later than entry or an emerging dragon. The same cycle happens later on this next bump of the dragon, which is a 10 period Bollinger Band plus or minus a half. When price takes out the upper skin, that becomes an emerging dragon not later than. The next thing I'm looking at are these blue dots, and now these are pocket entries where I've had a successful move after a P1, and a P1 occurred because I had a significant move here where price came out of the river, get the RLCO outside the river, and then a successful trade that went past the Bollinger Band mean, in this case to the far side of the floodplain and back. And now as the RL10 makes a higher low and starts cruising up, I can see I've got to enter not later than the yellow dot. And now in this little pocket that is formed by the elbow of the dragon, this is what we call the pocket entry in blue, and now I can get price improvement. So any entry between that blue dot and the yellow dot is reasonable in order to take advantage of the moves that we forecasted back to the VWAP or the VWAP extension. If I don't get this one, then I have this one. Same idea. It went to the Z2, held support, made a higher low. The RL10 crosses back over the dragon. I get my pocket entry here, or not later than price going through the upper edge of the dragon, and that's here. Now after this significant move, you can see again I draw my support level or my resistance level across the RL10 or the top of the dragon. That's my not later than entry. This is the pocket that is formed by the RL10 crossing the dragon once more. This is a place where if it were to fail back to the VWAP, it would occur here, but it didn't, and the RL10 crosses back over the dragon. This is my pocket. That is my not later than entry, and that still allows me the opportunity to enter and take advantage of this forecasted move. And again, these are moves from $63.75 to $66.75, so $3 on 60 cents. That's a 5% intraday move, and now we're looking at how we can forecast moves and calibrate moves and frame our moves to take advantage of intraday volatility of that magnitude. So the next step are to show my actual trades through here. My first trade is getting this P4, which is that lazy W, or taking the second leg up and getting it early here as the RL10 crosses the dragon. My entry, I observe these and say this trade is working. It gets through the VWAP. I can now be managing my exits to lock in pieces of these moves. When it clears this hump and I've got 2R in hand minimum, I make my second entry. It gets an excursion out to Z3 and starts to fail. This is where I took my exit, and so I scratch the second entry, but I lock in a little better than 2R on this leg. I'm now with a long bias. I'm waiting to see the next pocket entry. I buy it. It fails. I lock in because now we're coming closer to the end of the afternoon, and I don't want to get trapped. So this is one that did not follow through, and I exit. I still have a long side bias because we're above the VWAP, and there's not enough room from the fail back to the VWAP to entice me to enter. I don't see 2 to 1 available there. So I will make this trade in accordance with the RL270 when I see dips. In this case, I waited for the next confirmation. I saw that as a pocket. I didn't know if it was going to break through this resistance where it failed last time. This was the not later than entry for the dragon, and I entered at that level with the stop here at Z2. We get this last excursion during the day. It got most of the move back up to the projected height. It starts to roll over. We see the RL30 rolling over, and then that's enough for me to cash my win, which moves from 65.50 to 66 and a quarter, and that's about 1.5 R for me. And then as we're moving into the close, that's all there is, and there ain't no more. All right, so that's the development of our trade framing, and then showing how we actually apply that through a series of trades as they unfolded, along with some money management. So thanks very much for your kind attention. We'll see you in the chat room. Keep your risk measured and your powder dry.